of Management Studies, IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 4 International Business Environment, Unit 11 Balance of Payments, Part 2. Balance of payments and the central bank. The central bank of all countries holds reserves of foreign currencies which they can use to finance the deficit in the current account. For instance, a country, say India, has a deficit in current account worth rupees 200 billion and a surplus in the capital account worth rupees 180 billion. Then, there is an overall balance of payments deficit of rupees 20 billion. If the central bank, in this case RBI, intervenes, then it can meet the deficit by selling equivalent amount of foreign exchange to its importers for payments to foreign countries. However, in case of a capital account deficit, sale of foreign exchange by RBI may be required for foreign lending or repayment of foreign loans by the Indian residents. Such purchase and sale of foreign exchange reserves by the central bank are termed as official reserve transactions. An overall surplus in the balance of payment leads to purchase of foreign exchange assets by the central bank, which expands its stock of foreign reserves and hence increases the money supply in the economy. An overall balance of payment deficit, on the other hand, leads to sale of foreign exchange reserves by the central bank, which leads to depletion of its foreign exchange reserves, thereby lowering the money supply in the economy. Let us consider an example to understand. Suppose US has a current account surplus of 60 million US dollars and a capital account deficit of 40 million US dollars. This implies that number 1, there is an overall balance of payment surplus of 20 million US dollars, and number 2, if the Federal Reserve intervenes, then it will purchase foreign exchange reserves equivalent to 20 million US dollars and add to its stock of foreign reserves. And number 3, there is an increase in the net foreign reserves of the Federal Reserve. In case the Federal Reserve doesn't want to intervene in buying and selling of foreign exchange reserves, then the exchange rate, that is, the value of home currency relative to foreign currencies, will automatically adjust to eliminate the deficits or surpluses in the balance of payments. Such a system, where the central bank of a country doesn't intervene in the foreign exchange market, is called as fully flexible system of exchange or a clean float of the currency. Should a current account deficit, that is CAD, always be a situation of alarm? In an open economy, we know that Y equals to C plus I plus G plus X minus M, or M minus X equals to CAD, which is equal to C plus I plus G minus Y. Here, Y equals to income of the economy, C equals to expenditure incurred on consumption, I equals to expenditure on investments, G equals to expenditure incurred by the government, X equals to value of exports, I equals to value of imports, X minus M equals to net exports or trade balance. Here, C plus I plus G is the aggregate demand or planned expenditure of an economy, And why is the income of an economy? In case of a current account deficit, that is CAD, a country is spending more than its income on accumulating imports and builds up debts in the outside world. Whether a CAD is a cause of alarm or not, it depends on the nature of expenditure involved in the economy. A CAD will not be an alarming cause, as it might be offset with the help of some productive I or G in the economy. The debts plus interest that accumulates as result of deficit will automatically be repaid through the growth dividends generated out of those productive investment or government expenditures. In such a scenario, a CAD will be a sign of health of a robust economy. If the CAD is triggered by more of consumption or unproductive investment or government spending, then the CAD will indeed turn out to be a severe cause of alarm in the economy. How to finance a current account deficit or CAD? As we have discussed earlier, CAD may or may not be necessarily harmful for an economy. However, CAD can be financed through various capital inflows such as portfolio investments, external commercial borrowings, foreign direct investments, and NRI deposits. Trends in India's balance of payments. During the first quarter of the financial year 2020-21, India witnessed a sharp decline in both its exports and imports in line with the contraction in global trade. The decline in imports exceeded that of exports, which led to a smaller trade deficit of $9.8 billion compared to $49.2 billion in first quarter of financial year 2019-20. India recorded a trade surplus only in the month of June 2020 after a period of 18 long years. A gradual improvement in India's merchandise trade was witnessed post-unlocking of the economy due to COVID-19 pandemic from June 2020 onwards. The trade deficit during April-December 2020-21 was $57.5 billion compared to $125.9 billion in April-December 2019-20. Net service receipts remained stable, amounting to $41.7 billion during April to September 2020 compared to $40.5 billion in the corresponding period in 2019. This is because of the international mobility restrictions and falling remittances on the onset of the COVID-19 pandemic. The quicker recovery of the service sector was mainly driven by the software services, which amounted to 49% of the total service exports in 2020. India recorded a current account surplus, which is 0.1% of GDP in fourth quarter of financial year 2019-20 after a gap of 13 years after fourth quarter of 2006-07. This has been possible on account of a lower trade deficit and a steep rise in the net invisible receipts. The surplus continued successively in the first and second quarter of financial year 2020-21. A sharp fall in the merchandise exports and a lower outgo for travel services led to a sharper decline in current payments by 30.8% than current receipts by 15.1%, which led to current account surplus of $34.7 billion, which is 3.1% of GDP. It is expected that India will tend to end with a current account surplus of at least 2% of GDP given the trends in its imports of goods and services after a gap of 17 of GDP trends in its goods and a period of years. Net capital flows witnessed a decline in the first half of financial year 2020-21 at $16.5 billion as against $40 billion in the first half of financial year 2019-20 due to the net repayments of the external commercial borrowings and decline in the banking capital. However, net foreign investments saw an increase at $31.4 billion in the first half of financial year 2020-21 as against $28.7 billion in the corresponding period in 2019-20. Foreign direct investments, that is FDI, recorded an inflow of $27.5 billion during April to October 2020, which is 14.8% higher than the second half of financial year 2019-20. Computer hardware and software accounted for the highest FDI inflows amounting to $17.6 billion in April to September 2020 compared to $4 billion in April to September 2019. Addition of Indian stocks to the Morgan Stanley Capital International, that is MSCI, also played a major role in attracting foreign capital inflows. Foreign portfolio investments, that is FPI, too recorded a net inflow of $28.5 billion during April to December 2020 as compared to $12.3 billion in the corresponding period in 2019. This increase in the net FPI resulted on the grounds of immense support provided to the Indian equities by the abundant global liquidity, better corporate earnings in the successive quarters, and better management of the COVID-19 economic recovery prospects. India's external debt stood at India's external debt stood at $556.2 billion in end September 2020, which recorded a decline by $2 billion over that in end March 2020. External commercial borrowings, that is ECBs, which is the largest component of India's external debt, recorded an amount of $207 billion at the end September 2020, which is 5.8% lower than that in end March 2020. The stocks of NRI deposits, the second largest component of India's external debt, rose to $137.3 billion by 5.1% compared to that in end March 2020. The import financing trade deficit, the third largest component, shrank by 2% to $99.4 billion compared to that in end March 2020. Government debt, on the other hand, increased from $100.9 billion in the end March 2020 to $103.6 billion in the end September 2020. To sum up, India, being an emerging market economy, typically runs a deficit in the current account, which is being offset by a corresponding capital account surplus. However, India has been witnessing a current account surplus since fourth quarter of financial year 2019-20, along with increased capital inflows, which have led to an overall balance of payment surplus. Now let's summarize the unit. The balance of payments of a country summarizes all payment transactions and receipts by individuals, firms, and the government in a given time period. It has two major components, the current account and the capital account. The current account transactions mainly include the net value of imports and exports of a country alongside net transfers from abroad. The current account transactions mainly include the transactions involved in purchase and sale of assets across the geographical boundary. An inflow of funds in the form of foreign exchange reserves leads to a balance of payment surplus in a country, whereas an outflow of funds result in a balance of payment deficit. A surplus in balance of payment leads to purchase of foreign exchange reserves by the central bank, thereby increasing its stock of foreign reserves and money supply in the economy. A balance of payment deficit, on the other hand, is characterized by sale of foreign exchange reserves by the central bank, thereby reducing the money supply in the economy. The balance of payments can be in equilibrium only if the demand and supply of foreign exchange reserves are equal, that is, when the inflow and outflow of foreign exchange reserves from the country are equal. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Jagbandhu Jana. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.